The city never truly sleeps, but suddenly it grows quiet. Neon lights flicker over empty streets and the sound of slot machines is replaced by silence. Casinos, hotels, and entertainment venues once filled with international travelers are eerily empty. The lifeblood of Las Vegas's economy, the constant influx of foreign tourists, has vanished overnight. A travel ban, geopolitical tensions, or a shift in global tourism patterns has effectively removed millions of international visitors from the Strip. The consequences are immediate, dramatic, and far-reaching. The first signs of distress appear in revenue reports. Casinos, previously thriving on international gambling, see a sharp decline in daily profits. High-stakes tables remain empty, slot machines idle, and VIP suites sit unoccupied. Revenue streams that funded not only gambling operations but also hotel management, entertainment shows, restaurants, and retail outlets evaporate. Corporate executives scramble to assess damage, and investor confidence falters. Publicly traded casino operators experience precipitous stock declines as analysts adjust forecasts to reflect the absence of foreign cash flow. Hotels and resorts face cascading consequences. Occupancy rates plummet as bookings from international travelers disappear. Luxury suites, convention spaces, and boutique hotels see cancellations spike. Staff layoffs become unavoidable. Front desk personnel, housekeeping, concierge teams, and management all face furloughs or termination. Local contractors, from landscaping to security services, lose clients. The ripple effect spreads through the hospitality ecosystem, creating mass unemployment and economic instability in Nevada's tourism hubs. Restaurants, bars, and entertainment venues are heavily impacted. Fine dining establishments that cater to international visitors experience dramatic revenue drops. Concert halls, showrooms, and theaters cancel performances due to insufficient ticket sales. Nightclubs, lounges, and casinos close temporarily or permanently. The entire Las Vegas service industry feels the shock. Suppliers, from food distributors to equipment maintenance companies, face payment defaults and halted contracts. Economic stress radiates throughout the region, affecting both urban and surrounding rural areas. The labor market experiences severe strain. Tens of thousands of jobs tied directly or indirectly to tourism vanish. Unemployment claims spike in Nevada as workers lose income and social safety nets are tested. Temporary layoffs become permanent as businesses fail to survive prolonged revenue shortages. The population dependent on tourism wages faces financial hardship, housing instability, and reduced access to healthcare. Rural communities surrounding Las Vegas also feel the consequences as economic interdependence spreads the impact. Financial markets react swiftly. Publicly traded casino operators, hotel chains, and entertainment companies experience dramatic stock price drops. ETFs and mutual funds with significant exposure to tourism and hospitality are affected, causing ripple effects in global equity markets. Investors reassess the viability of U.S.-based tourism-dependent businesses, creating uncertainty that affects both short-term trading and long-term strategic investments. Hedge funds and institutional investors adjust portfolios, reducing exposure to risk-prone sectors. Local governments face revenue crises. Sales taxes, hotel occupancy taxes, and gambling license fees plummet. Public services, including education, infrastructure maintenance, and law enforcement, experience budgetary strain. Municipal governments in Las Vegas and Clark County must revise fiscal plans to address immediate revenue shortfalls. Emergency funding and state intervention become necessary to stabilize public services. The broader regional economy contracts as consumer spending declines. The broader U.S. economy is affected through interconnected sectors. Airlines lose international passengers, resulting in reduced flights to Las Vegas and canceled revenue streams. Transportation companies, including buses, taxis, and rideshare services, experience dramatic declines. Convention centers lose international attendees, affecting corporate event planning, technology showcases, and business-to-business services. Travel agencies and online booking platforms see reduced revenue and commissions. The absence of foreign travelers reverberates far beyond the city itself. Corporate supply chains experience disruption. Businesses reliant on tourism, from hotels to retail shops, scale back operations or close entirely. Contracts with suppliers, including food distributors, beverage companies, cleaning services, and entertainment production firms, are terminated or renegotiated under duress. The resulting financial strain spreads to suppliers in other states and international partners who rely on Las Vegas tourism as a business driver. Casinos and entertainment companies face liquidity crises. Operating expenses, from payroll to utilities, remain fixed even as revenue disappears. Debt servicing becomes challenging for corporations that financed expansion or modernization projects. Banks and lending institutions experience elevated risk exposure, particularly in regional markets dependent on hospitality income. Government-backed loan programs and emergency financial assistance may mitigate some losses but cannot prevent systemic economic stress. Stock market volatility is amplified. Securities tied to tourism, entertainment, and hospitality suffer massive value erosion. Market indexes reflect systemic concerns about economic resilience, particularly regarding regional dependence on tourism revenue. Investors factor in long-term uncertainty, reducing capital allocation to affected sectors. Global investors monitor developments, adjusting exposure to U.S. markets and redirecting investment toward less affected regions. Luxury goods and retail sectors tied to tourism are disrupted. High-end stores in the Las Vegas Strip, reliant on international customers for jewelry, fashion, and electronic sales, experience steep declines. Retail staff layoffs increase and corporate profits contract. Suppliers of luxury goods face delayed payments and reduced orders, impacting global supply chains and manufacturing hubs. Real estate markets are affected indirectly. Commercial properties designed to support hotels, casinos, and entertainment venues experience decreased demand. Office spaces, retail complexes, and condominium projects tied to tourism markets struggle to retain tenants or achieve financing. Residential real estate markets experience secondary effects as employment decline reduces household purchasing power. Housing foreclosures increase in impacted regions. Local culture and entertainment experience stagnation. Las Vegas's identity as an entertainment capital diminishes as shows, events, and attractions are canceled. Cultural institutions, museums, and performance centers face financial strain. Creative professionals, performers, and production staff are disproportionately affected, leading to an exodus of talent to other cities or sectors. The cultural vibrancy of Las Vegas, once a global draw, diminishes under prolonged absence of international visitors. International tourism patterns shift permanently. Alternative destinations in Asia, Europe, and the Americas gain market share as global travelers seek new experiences. Las Vegas loses long-term brand dominance in global tourism. Countries and cities competing for international visitors capitalize on U.S. dependency on foreign travel, reshaping global tourism flows. Las Vegas faces an uphill battle to restore its international profile, even after the travel ban or decline ends. Public sentiment and consumer confidence are affected. Domestic visitors may reduce spending due to perceived instability in Las Vegas's hospitality sector. Fear of further travel disruptions or economic uncertainty influences decisions about vacations, conventions, and corporate events. Tourism-dependent economies nationwide observe Las Vegas's struggles as a cautionary tale, affecting strategic planning and consumer behavior. Employment restructuring occurs over the medium term. Workers displaced from hospitality and tourism find alternative employment in unrelated sectors, leading to skills mismatch and wage suppression. Regional labor markets experience long-term adjustment challenges, requiring retraining programs, economic development initiatives, and social support systems. Public-private partnerships become crucial in restoring employment stability. Government and corporate strategies evolve in response. Incentives for domestic tourism, targeted marketing campaigns, and infrastructure investments are initiated to attract non-international visitors. Casinos and hotels diversify offerings, adjust pricing, and explore alternative revenue streams. Policy reforms at the state and federal level address dependency on international tourism, attempting to build economic resilience for future shocks. The stock market reacts to long-term revenue projections. Investors analyze the risk of recurring declines in tourism, competition from other destinations, and changing consumer behavior. Volatility persists in hospitality and entertainment sectors, influencing broader equity indices. Diversification and risk management strategies are revised to reduce exposure to tourism-dependent markets. Financial institutions and lenders implement risk mitigation strategies. Credit terms for hospitality, gaming, and entertainment firms are adjusted to reflect increased uncertainty. Loan provisioning, collateral requirements, and interest rates evolve in response to prolonged revenue gaps. Regional banks, particularly those tied to tourism economies, face ongoing scrutiny. Global economic ripple effects emerge. Foreign airlines, hotels, and entertainment venues that depended on Las Vegas travel revenue face secondary impacts. International trade in luxury goods and services declines. Investment in Las Vegas-based projects slows as risk perception rises among global investors. Strategic economic partnerships shift as international players prioritize markets with more stable demand. Infrastructure development stalls. Hotels, casinos, convention centers, and entertainment complexes delay expansion, renovation, or modernization projects. Construction firms face canceled contracts, layoffs, and delayed cash flow. Suppliers of construction materials experience reduced orders, affecting regional manufacturing and distribution sectors. Energy and utilities are affected indirectly. Reduced occupancy in hotels and casinos decreases energy consumption in some areas, but leads to financial strain for utilities relying on revenue from high-volume commercial clients. Maintenance schedules are disrupted as companies reduce operating capacity. Infrastructure resilience planning becomes a priority to maintain long-term service stability. Tourism education and workforce training programs experience disruption. Hospitality and culinary schools, convention management programs, and entertainment arts education see decreased enrollment and funding. Students face uncertainty regarding future employment opportunities. Long-term human capital development is affected as the pipeline of trained professionals diminishes. Corporate mergers and acquisitions slow. Companies dependent on Las Vegas tourism defer strategic growth, acquisitions, or investments due to uncertainty about international visitor return. Global competitors exploit the slowdown, gaining market share in adjacent tourism markets. U.S.-based firms struggle to regain momentum post-disruption. Long-term economic recovery requires strategic diversification. Hotels and casinos invest in domestic tourism campaigns, event hosting for national conventions, and entertainment packages for local markets. Alternative revenue streams, including online gaming, entertainment streaming, and domestic business partnerships, are pursued. Government support and private sector collaboration are essential to stabilize the economy and restore investor confidence. The financial and social lesson is profound. Reliance on a single source of revenue, particularly international tourism, creates systemic vulnerability. Stock markets, local economies, and national economic indicators are intertwined with global travel patterns. Risk mitigation, diversification, and strategic planning are essential to prevent catastrophic disruption from external shocks. Ultimately, the absence of foreign travelers from Las Vegas demonstrates the fragility of economies built on tourism. Stock market volatility, corporate financial strain, employment disruption, and social consequences illustrate the interconnectedness of global travel, commerce, and local prosperity. Recovery is possible but requires proactive planning, diversification, and adaptation to a world where international tourism is no longer guaranteed. The story of Las Vegas's potential economic collapse is a testament to both risk and resilience. It emphasizes how concentrated economic activity, dependence on external factors, and systemic vulnerabilities can amplify the effects of sudden global shifts. The city's future, like its past, depends on adaptability, innovation, and the ability to attract diverse sources of revenue.